All right, we are live. First show of 2021. Welcome, as always. My name is Alfred from DiversiFi Capital, and we got Raymond joining us as well for our Dfi-nancial Friday show. First off, Raymond, welcome back. Hope you had
Yeah,
a nice break.
happy
How have
New
you
Year.
been?
Good. It's nice to kind of get that little break before year end, and 2020 started off pretty crazy too, but still being pretty optimistic about the rest of the year. So,
Yeah, lot
how
to
about you?
talk about, and we'll get it started soon. But again, Happy New Year,
Yeah.
right? Welcome back. Welcome
Mhm.
back to our show. We've got a lot planned for us this year, and we're just excited to be back. I'm ecstatic to be back here, talking about finances again. Of course, as Raymond mentioned, New Year, same crazy. And something that we'll talk about in just 1 second, address it a little bit, give you a little bit of our thoughts as well. But today's show, what do we got on hand? We got a little bit of retirement accounts that we're going to talk about, primarily talking through these channels of not just Roth IRAs, but some methods of contributing or converting into Roth IRAs. It's been around for a little bit now, right? But it's called backdoor Roth, and now some people have these ones called mega Roth, mega backdoor Roth,
Mhm.
right? Crazy terms, right? And we will break that all down today for you guys to understand a little bit more about what this would mean for you. Is it available to you? And maybe what some of the pitfalls would be in, contributing or not contributing. So Raymond and I, we're going to address all of that. All right. But before we get started, of course, right, we're coming through you live through our channels here, and not providing necessarily personal financial advice because we don't know your specific situation. Raymond and our goal and the show's goal is to make sure that you're asking the right questions, right? You're hearing us talk generally about some of these topics. But if it is something that you're interested in learning more about, visit us on our website, diversificapital.com, to learn more about how you could do that. Remember also, especially today, we're going to be talking about retirement accounts here, right? So there's going to be tax knowledge that we're talking through, but we're not acting as your tax professional, okay? This is something that you should be inquiring with your tax professional, your personal financial planner, to understand more about your scenario itself. And of course, if we do talk about investments, we're not soliciting you to buy any investment products, and anything that we talk about is more for general knowledge. All right. Why don't we talk about the market update? I mean, first week of the year, right?
Yeah.
Crazy start to the year, right? And look, we're gonna look at the markets below 1.6% S&P,
Mhm.
1.54 or Dow, and 1.88 Nasdaq. What are you
Yeah.
seeing that's causing the markets to actually go up this week?
Yeah. I mean, even with all that's been going on, I mean, Monday didn't start off that well. Right? I think it was a little scary.
Understatement of the year already, Raymond, right there.
This Monday the markets were down, right? And hopefully that wasn't something that was forecasting what we're going to see for the rest of the year. But we did definitely see some rebound, and the market has just been really resilient. In terms of what we've been seeing from the news this past week, it's been once again pretty crazy. But knowing that there's been a sweep of the Georgia Senate there under the Democrats were one of the big items. The certification of Biden becoming the president, right? That happened midweek, and took until Thursday morning for them to certify that. But that's when the market jumped back, right? Once we had, once again, more certainty around the presidential election there. And even since then, it's always been that light at the end of the tunnel that we keep speaking about in terms of vaccines, right?
Mhm.
It hasn't been going out as quickly as they're planning to. But there's that as one thing, and the other thing is that not everyone is on board to start to utilize it right away. Even people who are on their front line are being offered it, but they're being a little bit hesitant, right? Just for how quickly we're able to get this vaccine. So it's kind of a mixed bag there, and hopefully, things do work out, and we start to see some normalcy in the second half of this year. But
Yeah.
those coupled with all this other items, was kind of what led the market this week.
Look, I mean, what's normal nowadays? I don't know, Raymond. I mean, I'm going to be
Yeah.
honest here, right? Like, I'm going to take a moment and say, I'm not going to downplay how wild Monday and Tuesday, the beginning of this week is. I mean, it's upsetting, right? These are, of course, my opinions on it, but I think for the country, it's going to be a dark moment and a dark day for a long time as we look back on it. It was an attack on how the democracy should work. And, I am glad that they went through that and came back late at night and did certify, right, the Electoral College votes and provide some stability to what it probably would have been a very wild morning, not only in the markets, but emotionally, right? And I think you and I are both this way. You and I are both optimists. And, I think the main thing is we both know people that have different beliefs. And I think the main thing for me, hopefully, what I've learned over the past 4 years is people are going to have different viewpoints, but the divisiveness of it is really something that upsets me. And, I hope more people can sit down and have conversations with the other side, have conversations, take action, but the conversations themselves, I think sometimes are not being had, and assumptions are taken right off the bat that if you're on the other side, these are your beliefs. Look, pause, take some time, understand that maybe your friends or people that you thought were friends are still that way, that primarily if you can sit down and have a conversation, find some common ground, because the world needs it. The US needs it, right? The divisiveness has been really, I think, hard for myself, and I know you too, Raymond, that bothers us, right? Quite a bit.
Put out some more compassion out there in the world, and just be open-minded to each other and listening, and just stop being one-sided. And that's really what that has been in terms of the vision that you speak of, right? And that we're also seeing too, as just being here in the US. So
and I think from a standpoint of like, how is all this happening yet markets go up? I mean, ultimately this is a financial show giving you guys a little bit of a guidance of like, why is this the case? I think while emotions were running extremely high, some things got settled out, right? The idea that, right, the Biden administration took one more final step, right, towards achieving, right, or becoming president, that's something that is an uncertainty that the market takes away. The market is very quick to jump to these things about what's going to happen, as you've heard us talk about, over the next 6 months or 12 months. And what we know now is the likelihood of that happening is at 100%. Like, he is going to be the president of the United States. And that was just one more step closer to that. So the market likes that. And then pair that up to what you were saying, Raymond, with the Georgia runoffs, right? I think mainly is stimulus checks going back out, right? Of instead of $600, potentially $2,000. The initial viewpoint of that, right, is that that's hopefully going to put more market or capital into the hands of consumers, and maybe that helps us recover a little bit better. Look, there's going to be varying arguments economically about the long-term impact of that, and maybe we'll get to that in another show. But I think if you're talking about just this week, that's been something right off the bat, that because of how the Georgia runoff elections went, that there's going to be a high likelihood that this is going to be passed now. That's been a nice positive jump on it, right? And so, to a lot of our clients, there's definitely been a surprise. And if you haven't been watching the markets, you're probably surprised to see those numbers at the bottom, right? That the markets are up over 1.5%, almost to 2%, continuing really the rally that we've seen all right the second half of last year and now into the first week of this year. So we'll see. And I think a lot of questions came through about Bitcoin as well. Bitcoin is over $40,000 of Bitcoin, right? I think I looked at the data. I think it was over a past 3-year span. Tesla, which has been a high flying stock, up over 1,000%, I think, over the past 3 years. Bitcoin was something like 6 times that, over 6,000%. Okay. It's just a wild ride that Bitcoin has had. And so the question has is like, what do you think of it? Look, the idea, I think, is to think of it as new age or new generation gold, right? Because people are thinking of it as a hedge to maybe all the stimulus money, the inflation that might be happening over the next couple of years in the US with all the money being printed. People are running to something that's a little bit more decentralized, right? With limited supply, like a gold. So gold has been doing well, and so has Bitcoin, just in a different volatility, right? In a much higher trajectory on ups and downs. Okay. But yeah, from a market standpoint, I think you have something where less uncertainty now of at least the U.S. Government. And so from that perspective, that has boosted things a little bit here. Okay. So, all right. Now, we've got the market update out of the way, and we're going to talk a little bit about Roth IRA. So there's a variety of different ways we can approach it, right? And generally, if we're talking to clients about retirement accounts, we would want to break down and understand first, like, what is an IRA, or just what are retirement accounts? Like, why would someone be putting money into these accounts? But I won't get into so much of that today. We have a limited amount of time to be going through this. So specifically, we're going to focus on Roth IRAs. Okay. So Roth IRAs, well, actually, Raymond, tell us a little bit more about the idea of the Roth IRA account. Like, what, how does money come in? How does it come out? Like, why do people put money into Roth IRAs?
Sure. Yeah. So, I mean, the opposite side of it would be a traditional IRA or a pre-tax portion that I think more people are familiar with. But within a Roth IRA account, you're actually putting in post dollars into this account, allowing it to actually grow tax deferred, similar to a regular IRA account. But also, you're able to withdraw it tax-free, like truly tax-free. Now, there are going to be some rules that we'll talk about today in terms of being able to withdraw it tax-free. But it basically allows you to take money that you receive from your paycheck, right? So that's considered after-tax money, invested into a Roth IRA account. And once it's within the Roth IRA, once again, it grows tax deferred. But really the beneficial part of that, if it continues to grow and grow and grow over time, when you start to take money out of the Roth IRA account, you no longer have to pay taxes on it again. Now, that can be a really great benefit, right? To not have to worry about taxes on that portion of money ever again. But, there are considerations to understand when we are putting money into a Roth IRA, and it kind of falls back into just taxes, right? Where you stand within the tax bracket this year, and hopefully that we're going to be assuming that in the future that it'll be at something lower, right? So
yeah. And what you're saying is why someone should be putting into a Roth IRA, right? It's the assumption that if I'm already paid tax on this money and I contributed to this Roth IRA account, and I don't pay tax on it in the future, if I had a vehicle that would allow me to defer the tax today instead, it depends on which one is higher. Do I think my tax rate today is higher than it's going to be in the future? Or do I think it's going to be lower today than in the future? Or some people just say, I'm worried about, I'm so uncertain about what taxes are going to be in the future. I would rather pay taxes on it today because I know what it is. And I could take that future tax out of the picture by being in a Roth IRA, right?
Yep.
Now, I think it's interesting because, sounds like something that most people may want to start thinking, oh, that, if I'm never going to pay tax on this again and I have paid tax on it now, I want to contribute to it. But wait, okay, there are income limitations generally about contributing to Roth IRAs. Okay, so when we're talking about thresholds and contributing to retirement accounts, this is separate right now from talking about 401k. So we'll get to that in 1 second. Right, we're going to tackle the idea of the IRA and the backdoor IRA first. Right, but if you're married filing jointly, right, as of right now, if you're making between 198 to 208,000 of adjusted or modified adjusted gross income, just think of it as if you're making somewhere between 198,000 to 208,000, by the time you exceed $208,000 worth of income generated and made, you're not able to actually contribute directly into this Roth IRA. Okay. And by the way, the contribution amounts that anyone as an individual that can contribute to an IRA is generally $6,000 on an annual basis. And if you're over 50, they give you a little bit more, right? They give you a little bit more money to try to catch up if you're behind and let you contribute an extra $1,000 for a total of $7,000 to contribute to this account. But specifically with the Roth IRA, if I wanted this kind of after-tax and tax-free growth in the future, you have to be under a $208,000 income level to be able to actually contribute to the account, right? And so depending on if that's the case or not, if you're under those levels, hey, you know what? Go ahead, if it makes sense for you, right, to be actually contributing to this Roth account, if you have the money to be saved, I think that could be a really good idea. For our young clients that might be watching this, or our clients that are watching with young kids who's working, hey, that might be a really good idea for them to contribute to a Roth IRA. We actually get that a lot because the kids just started working. They maybe be in a lower tax bracket now than they would be in the next 10, 15, 20 years. If they learn how to save that right now and their tax rate is lower, they can take that money, pay tax on it, contribute to a Roth, and never have to pay tax on it again. So we actually see that happen a lot for someone who's young, started out in their career. Okay.
Actually, there's one point to make to add to that is that you need to have earned income, right?
Yeah.
So it's not something that if you have saved up within your savings account, but you didn't work for the year, you aren't able to contribute to an IRA or a Roth IRA. So you need to have earned income, which generally consists of like W-2 wages or self-employment income. So dividends, interest, or investment performance, that doesn't count as earned income.
Really good point.
Exactly.
Yeah.
So just wanted to make sure that's earned income. So if you earned $3,000 for the year, you're only able to contribute up to the $3,000 into a Roth or an IRA account. So just want to make sure that's there. Unemployment benefits does not count as earned income either. So just want to put that clarification there.
Which, you know, again, a fantastic point to make for a year like this year, right? Where a lot of people are on unemployment or have been on unemployment, right? That itself isn't counted towards earned income, right? So remember, the topic is backdoor Roth, right? And these mega Roth accounts. Why these additional terminologies around Roth accounts? Well, it starts to apply when we're starting to think about people making income over these levels of 208,000. All of a sudden, they're not able to contribute directly into a Roth account, right? And so somewhere along the way, probably about a little over a decade ago, there were some rules passed in Congress where they said something like this, which is, hey, we know that there are income limitations that we've applied for you to be able to contribute directly to a Roth IRA, but we're going to remove the income limitations for someone trying to convert any existing IRA money. So existing IRA money being money that was not been taxed yet, or pre-tax, or something that you rolled over from a 401k. So something that, again, is pre-tax. They're like, why don't we remove the income limitations on a conversion of a Roth, conversion of those funds into a Roth, primarily because I think so that the government could have generated more tax revenue, right? Because if they promoted and allowed this to happen and remove income limitations, then people are going to consider, hey, maybe it makes sense for me to convert $100,000 IRA that I've saved up. I want to pay tax on it now, and they make the conversion. Well, the IRS gets, or the government gets, tax revenue from it. So I think that was maybe part of the reason why they did it. And I think an unintended effect of that, though, was that they just simply said, right, any existing IRA money, right? And so here's where, follow me, it's not a difficult thing to understand. It's actually a fairly convoluted idea to understand, but I'm going to try to do my best to simplify it here. And the idea is, if I can find a way to put my annual contribution of $6,000 into an account, if I didn't have any IRA money before, and then consider that $6,000 as my existing IRA money, then I can then take that $6,000 subsequently and convert that over to Roth. Now, look, this is, I mean, I would probably consider it a loophole or unintended effect, but look it up. It's called a backdoor Roth. It's been talked about for almost more than a decade now, about a strategy about how to get money if you're over the income limitations, right, into an account. And so the ability to do it is there. Okay. Is it what the IRS intended? No. Right. Are you what these laws intended? No. So be careful, right? Take it at your own risk. But I'm just explaining to you what the backdoor Roth is. Okay. Now the $6,000, you might ask, well, if it was pre-tax and I convert it, wouldn't I have to pay tax on it? Yes. If it was a contribution of $6,000 that you made into an IRA that you deducted from your tax return, meaning you didn't pay taxes on that $6,000 yet, then yes, when you convert it, you have to pay tax. But I think what people don't realize is you can put $6,000 into an IRA account in any given year, decide to not deduct it from your tax return, and just have it there. Okay. The only benefit of doing that is it grows tax deferred, meaning if you make transactions, there isn't any capital gains that happens while while you're making those trades.
Yep.
But when you take it out and it stayed in that type of account, you would actually still have to pay tax on the gains. And so by putting $6,000 into an IRA account and not deduct it from your taxes, there's no income limitations on that. There's nothing that says that you can't do that, right? The income limitations on the IRS rules state specifically that you have to be under a certain level of income to be able to deduct it from your return, and you have to be under a certain level of income to contribute to a Roth IRA. Okay, but there's nothing that says you can't just put $6,000 into a IRA and not deduct it. And so I think that's where people started to say, well, if I put the $6,000 in, I think I can then go ahead and make the conversion at some point down the line and consider that my existing IRA money. So that's what a backdoor Roth is, okay? Basically allowing somebody who might be over the income limitations to be able to actually make an indirect contribution to Roth. Now, there are additional rules, limitations, and kind of pitfalls, especially if you have IRA money, maybe a larger account that is not part of this $6,000 that was already pre-tax, meaning you haven't paid tax on it. Okay. You have to be careful there because the paperwork around that, how it actually applies to the new 6K that you put into the account gets very messy. Okay. So what you're going to want to do is, if this is more so a situation where you don't have any IRA money, right? You are starting to make enough money as a family or a household over $200,000, right? By the way, this kind of thought process, okay, this thought process is something where if you're single, right, it's going to apply, but you want to look up the limits of, are you over the Roth IRA limitations as well, okay? Once you talk through and think through, should you be deducting or can you be deducting these contributions, or can I be contributing to Roth? And you're saying, look, I can't actually do it. I need to find a different way. This is where it could apply to you if you don't have any other IRA money outstanding. Because if you do, again, it's going to get messy, and it's probably not something that you should do on your own before reading more or talking to someone about it. Okay. All right. So now that we've gone through what the backdoor Roth is, there's something now called a mega backdoor Roth, or just maybe called a mega Roth. And different companies will call it different things. What other names have you heard of, right, being called, Raymond, like outside of that mega Roth?
Generally just hear it as like an in-plan conversion. Something
Yeah.
that they'll also call it as well. That's probably more the technical term of it. I think mega Roth was just created in a way of how beneficial that can be for clients to be able to contribute into a Roth type of vehicle. Now, there is a difference between a self-directed Roth IRA, which is just Alfred was talking about with the regular IRA, and Roth IRA. But when it comes to 401k plans, there are a different set of rules, right? And how I like to think of it is, think of a 401k plan as your employer. Well, technically it is your employer who created that plan, and you're underneath that plan. Okay, so they have their own set of rules. There's the ERISA rules as well. That's part of it. So for more of a governmental overview of these type of plans. But specifically for a Roth, there is no income thresholds for 401k plans as there is with a self-directed Roth IRA that we just talked about. So there's one key difference there.
And you're jumping into, right, this mega Roth idea, which is something that really would only be offered through your employer. Okay. So to Raymond's point, we had talked about the backdoor Roth, which is anyone, right, as long as the income limitations apply, could have this available to you if you have earned income. Now we're shifting over to your employer sponsored plan, your 401k plan. And in that 401k plan, you can make contributions, right, on an annual basis up to $19,500 that you can contribute as part of your employee deductions from your paychecks. You go into the company portal, you select what percentage I want to deduct. So many of you have seen this before. And then it's going to ask you, do you want to make a traditional 401k contribution or a Roth contribution? Now, when I say that, I'm not quite talking about the mega Roth just yet. This is just the general 19,500. And in most cases, most employers have that available where you can choose to put towards the traditional 401k and choose, right, to put towards the Roth 401k. Again, one before tax and one they take taxes but grows tax-free forever. Now, what's interesting is in some employers, more common last year, right? We saw quite a bit of firms across the US, but a lot of them in the Bay Area, decided to offer this additional piece called the mega Roth. So where does that stem from? Well, the IRS rule suggests that on an annual basis, the plan, the 401k plan per person, inclusive of that 19,500, inclusive of whatever the company might be matching on your contributions, and maybe what they call profit sharing into the account, there's a total of about $57,000 that they total up that you can contribute annually. Okay. So what they then did was thinking, well, what if we allowed people to contribute to the account outside of that 19,500 into this after tax portion, basically a new portion of an account that they set up, and then apply something that they call an in-plan conversion. All right, you might be like, what is going on? Like, why is it so complex? Because I think a lot of the bigger companies realize now, maybe as an employer benefit, something that they just want to be able to provide as much opportunity for people to save towards these accounts as possible, right? So for somebody who has maxed out the 19,500 towards these accounts, you may want to check with your employer, and you have to check first because I would actually argue a majority of people don't have this kind of after-tax account that allows for an in-plan Roth conversion. The simplified term of that is the mega Roth. Okay, so if you're Googling a search or looking it up, right, or asking your employer, ask about do they have a mega Roth? Do they have an in-plan Roth conversion? Okay, because if they don't, then unfortunately, right, what we're going to talk about next isn't going to apply to you, right, because it just has to be something that the company offers. But if they do, right, if they do, what they're saying there is they're allowing you to put now additional money above and beyond the 19,500 up to a total of 57,000 into this after-tax account, and then subsequently allowing you to convert this to Roth. Okay. And at the end of this process, what actually then would happen is you end up with whatever that annual contribution is in a Roth account. And there's no income limitations on that, right? There's nothing that says, because this is individual to the 401k plan, there's no income limitations like what I just said in the self-directed or your personal IRA side. There's also generally less forms to deal with about filing. There's less forms that you have to file on your tax return because it's all encompassed in this, right, 401k. And by the way, the first time I read about it almost 10 years ago, I probably spent like a good week, 2 weeks, 3 weeks believing that it was not true. Like it's too good to be true. Okay. Because it's still today, I think it's too good to be true. We're talking about an ability for someone who's making enough income to contribute, in some cases, over $30,000, right? Because if you take 57 and subtract it from the 19.5, over 30 some odd $1,000 that they could be putting into this account as Roth. And, it's happening. Okay. It's something that is certainly adopted by a lot of companies right now. And maybe at some point, right, the IRS will say, hey, you know what, like this is happening. We don't like it, whatever the case may be. Again, maybe not what they intended, but certainly as of today, more and more companies are adopting this mega Roth type plan. So go check it out. Go check if this is available to you, because if it is, it's a very powerful tool for someone to be putting right over almost 6 times the annual IRA contribution limit, right, into their own 401k plan that ultimately becomes Roth and never is taxed again, right? And so I think even as I'm talking about it right now, Raymond, it still blows my mind that actually is available, right? And so what do you see though, right, as we close out the show here? Like, does everyone that we encounter that has this available contributing to it? Like, what are the type of people that you see that generally is able to contribute to an account like this?
Yeah, so as you mentioned, once people are able to max out either their pre-tax or Roth contributions, the $19,500 that people are probably most familiar with, if they're wanting to contribute more, and they run into the issue with contributing to a Roth IRA directly, outside like with self-directed accounts, then they might want to go this route in that case, right? To be able to contribute more than the normal $19,500 up to their amount, right? So that $57,000 that you spoke about is also part of matching for that you receive from your company as well. So the remaining amount after the matching and your $19,500 would be the amount that you can contribute. So, we see clients, utilize that, especially if they are trying to do the backdoor Roth, right? It's just a little bit more work to have to go out there and create an IRA account, contribute to it, convert it, as compared to getting this done all within the 401k, as you mentioned, right?
Yeah.
So that is something that the backdoor was something they're already doing already. They might be just easier to switch to the 401k once they start offering that. Now, we're definitely glad to see that companies are offering it more and more now. There are probably a little bit of paperwork to get the in-plan conversion completed, but we know that there are some that try to help automate that as well. So a lot of information that you can find out from your HR department to determine if this is something that they offer and whether it's suitable for what you have now, right? In terms of extra income that you can save towards another retirement vehicle.
Yeah, exactly. Right. Our motto, start asking the right questions. I don't think many people are asking the right questions sometimes about these things, whether it's available or not, right, at your company. So start asking those questions, right? Is there an in-plan Roth conversion? Do we have a mega Roth, right? And to Raymond's point, look, it's not, even if it's available, it's not for everyone, because we're talking about not just saving 19,500, which in a year like last year where income maybe was difficult to come by, not everyone has that 19,500 to save, let alone more than that, right? And so it does fall into a category where if you have significant income and you can't contribute to a Roth outside of the IRA, but you have this available, it is certainly something that instead of taking that money via your paycheck and saving it into a normal investment account, you can actually say, well, hey, look, I'm saving it anyway. It wasn't like I was trying to use this money for anything in the short run. I can put money into this Roth account, because you have to be very careful. Once you put this money into the account, there are a different variety of rules, right? That will limit you from pulling that back out, because it is something that got converted. There's rules about how long, right? Typically, there's something called a 5-year Roth IRA rule, basically needing that money to be in the account for 5 years before you're doing anything with it, right? You have to watch out for those things. And the assumption should be, if I put money into this account, it's because I know I can keep it there until my retirement. All right. Awesome. Threw a lot of information at you guys for the first show of the year. I know it's going to be a heavy show, but I also realize that this has been a very a common topic that we've gotten over the last 3 months, because companies have been adopting this. So as much as this is for our live streamers watching this, it's also for our clients to go back and watch this as well, which many do. And so we hope that this is helpful information. We hope that you start asking the question about, does it make sense for you to be contributing to Roth, right? That's very important too, to say, are we aware of our spending? How do we get to a point that we can save before we even get to this level of talking about where to save money to? All right. Happy Friday, guys. We are so, again, excited to be back here. I love being able to talk to you guys about these topics. And we're going to be on again next Friday, same time, 3 p.m. Pacific. And we hope to see you guys very soon. And hope you guys have a wonderful weekend. Raymond, thank you again for joining us. It's always so nice to have you here. And we'll have you back on our show next week to discuss more finances.
Awesome. Nice talking with you, and everybody else. Have a great weekend.
Thank you so much. Bye.
All right. Bye.